Welcome to the Deep Dive. We're here to help you get up to speed on the key financial insights moving the markets. Today, we're digging into Sleep Number's second quarter 2025 earnings call. Happened back on July 30th. And this one's interesting because it's not just, another report. It's really a look at a company starting what the new CEO is calling a major hard reset. So our plan today is to cut through that corporate speak, pull out the really important stuff from the call, and figure out what it all means for the business.
Absolutely. And it's a fascinating contrast, really. You had management painting this picture of decisive action, big strategic shifts, but then the market. The immediate reaction to these Q2 numbers was, pretty quiet, subdued. Suggests investors are being pretty cautious here. We need to unpack why there's that difference in perspective. What are the signals you should be watching?
Okay, let's do it. Let's start with the numbers, the results for Q2, ending June 28th. Sleep Number reported a GAAP earnings per share of negative $1.09. Now, analysts were looking for something like negative 11 to 13 cents. So yeah, a really significant miss there, much worse than expected.
I thought you missed, totally.
And revenue also came in light, about $328 million. That's down nearly 20% year over year, missed the consensus by around 8%. So tough numbers on the top line, tough on the bottom line too.
Yeah, those headline numbers, they definitely grab your attention.
Yeah.
But if you dig just a little bit deeper, there are some interesting nuances in the financials, like the gross margin, for instance. It actually held flat compared to last year, 59.1%. Management even called it, I think the quote was, shockingly good, given how much sales dropped.
Shockingly good. How did they manage that with sales falling so much?
Well, they pointed to pretty aggressive material cost cuts and apparently some real gains in manufacturing efficiency. And it wasn't just gross margin. Operating expenses, if you exclude the restructuring costs, they were down substantially, 21% year over year, dropped $51 million just from Q1.
Wow. Okay, so serious cost cutting happening.
Serious cost cutting. And that helped adjusted EBITDA. That came in around $24 million. The margin was 7.2%. That's actually up 30 basis points year over year, so 0.3%, driven entirely by keeping a really tight lid on costs.
Okay, that makes sense. But what about their debt? With earnings down, are they staying within their loan agreements?
That's a critical question. Their trailing 12-month leverage ratio, measured against EBITDA, that's earnings before interest, taxes, depreciation, amortization, and rent. It stood at 4.56 times. And importantly, that was still below their maximum covenant limit of 4.75 times.
Yeah.
So yes, they're still in compliance. That EBITDA figure, by the way, it's often used for retailers like them with lots of leases, gives a better sense of their ability to cover obligations.
Gotcha. Okay, so the numbers show, a real sales decline, but also a company hitting the brakes hard on spending to stay afloat. Now let's talk about this hard reset thing, this big strategic shift. It's being led by the new president and CEO, Linda Findley, who just joined in April, right?
That's right. And she seems to have hit the ground running, challenged the team immediately to, question everything, act boldly, quickly. One of the first big moves, bringing in Bob Ryder as interim CFO in July. He's got a background in public company turnarounds.
And the previous CFO, Francis, is out.
Yeah, that change happened alongside Ryder coming in. And what's really striking is how fast Findley moved on things she saw as inefficient, especially marketing. She said pretty directly that marketing spend had been outsized and highly inefficient, particularly in Q1 of prior years.
So she didn't just trim it, she took a big swing.
A massive swing. A 30% cut in marketing spend year over year in Q2. And they were very clear. This was deliberate, a strategic choice, and they knew it would hit revenue in the quarter. It wasn't just about saving money. It was, like you said, a complete reset of how they approach marketing, forcing a rethink.
And this reset idea, it went beyond just marketing, didn't it?
Oh, absolutely. They expanded their whole cost-cutting program, big time. Now they're targeting over $130 million in operating expense cuts for the full year 2025 versus 24. Their old target was, $80 to $100 million? So they've significantly upped the ante.
Over $130 million. Where are those cuts coming from?
They describe them as deep and broad across the whole organization. Streamlining G&A, that's your general administrative overhead, and also R&D, research and development. Really sounds like they're trying to strip out complexity and run much leaner everywhere.
That is ambitious. I mean, cutting that deep, especially in areas like R&D, is there a risk they cut too much, hurt future growth or the customer side?
That is the absolute tightrope walk, isn't it? You hit the nail on the head. Management seems to be betting that they can get marketing working more efficiently before they have to make cuts that could genuinely damage the core business long term. The market's caution probably reflects exactly that risk. But look, connecting it back to marketing, the goal is efficiency. They took the hit on revenue from cutting spend, but they're already reporting significant improvements in cost per acquisition, so getting customers cheaper. And they mentioned a 24% jump in conversion year over year in Q2, and that trend apparently continued into July.
Okay, a 24% conversion lift is pretty substantial. That suggests spending less, but maybe spending smarter, might actually be paying off on the efficiency front.
Exactly. The idea is that when they do start reinvesting in marketing again, it'll be much more effective, a more data-driven approach. It feels like a shift in how they even think about acquiring customers. In this environment, that kind of efficiency gain could be huge.
And beyond marketing, you mentioned product changes too.
Yeah, they're overhauling the product portfolio as well, simplifying the lineup, bringing in new price points, making improvements to comfort and durability features.
Is this based on customer feedback or?
They said it's based on extensive consumer research, plus leveraging all that sleep data they have. What was it, over 30 billion hours? It sounds like they want to make it easier for people to choose, maybe broaden the appeal a bit. Standard turnaround stuff, really. Simplify, focus.
And when do we actually see these new products?
They expect those to start rolling out in early 2026, which, brings up the question of how they sell them. Their distribution strategy.
Yeah.
They mentioned exploring new channels, digital-first ideas, retail partnerships, other platforms, while still looking at their own store footprint.
So not ditching their stores, but adding other ways to buy, diversifying?
Precisely. Build on the vertically integrated model. Don't just replace it. But crucially, any new channel has to maintain a strong margin profile. They don't want to just chase sales if it kills their profitability. That balance, expansion versus margin, that's key.
Right. And for any company doing this kind of reset, the financial foundation is everything. You mentioned they're talking to lenders.
Correct. Management confirmed they're in active and constructive dialogue. That's the usual phrase with their lenders, trying to get more financial flexibility. They're looking at refinancing, other options that don't involve issuing more stock non-dilutive options, basically trying to get more breathing room to execute these changes faster. It shows they're being proactive, managing the balance sheet through this transition.
What about cash flow? That's always a worry during big shifts.
Yeah, they touched on that too. So they've improved processes around working capital, capital spending, all key for generating cash. And here's the big one. They're aiming for break-even free cash flow in the second half of this year, 2025.
Break-even free cash flow. So basically, stop burning cash.
Exactly. Generate enough cash from operations to cover investments needed to maintain and grow the business. And they were very clear. The number one priority for any positive cash flow they do generate, paying down debt,
Right.
all while planning to stay within those debt covenants we talked about. It signals a real focus on shoring up the balance sheet.
Okay, let's look ahead then. What did they say about the outlook for the rest of 2025?
For the full year, they expect net sales around $1.45 billion. That's still a decline, about 14% year over year. But they see the second half being roughly similar to the first half in terms of dollar sales, which actually means the rate of decline should slow down to about 9% year over year in the back half.
Why is slowdown and decline?
Partly because the comparisons to last year get a bit easier. And also, 2025 has a 53rd week, which gives them an extra week of sales compared to 2024.
Okay. And margins in the second half. Does the cost-cutting effect continue?
They're projecting gross profit margin around 61% for the second half. So, yeah, a nice improvement continuing that trend. They attribute that to, again, marketing efficiencies, but also better average revenue per unit, getting more dollars per bed sold through tweaking the product mix and promotions. And this guidance apparently already accounts for mitigating tariff impacts. Full year operating expenses, excluding restructuring, expected around $830 million. That's the $130 million reduction compared to 2024 we mentioned. Ambitious goals.
Right. So management sounds confident in the plan, projecting margin improvement and slower declines. But then you have the market reaction, which was, well, pretty brutal right after the call. Shares dropped hard. What explains that disconnect?
Yeah, the stock fell, over 17% pre-market that day, closed down 14%, big volume. It really highlights the split view. The market, or at least the initial reaction, was clearly focused on the big EPS miss, the revenue decline, the leadership churn with an interim CFO. Those are all classic red flags, right? Signs of instability.
Keep on uncertain.
Exactly. Whereas management was pointing to the future, improving marketing efficiency, stronger gross margins coming the second half, the cost cuts taking hold. Proof the reset is working. It's that classic tension. Market focused on current pain, management focused on future gain. How that story evolves is really what to watch now.
So for people listening, trying to figure this out, what are the key things to watch for? What milestones would show this hard reset is actually gaining traction?
Good question. There are definitely some near-term catalysts or maybe just checkpoints you should monitor. First, any updates on those lender talks, getting more flexibility would be a clear positive. Second, proof that those marketing efficiency gains the conversion lift. Lower acquisition costs can be sustained as they maybe start spending a bit more again. Does it hold up? Third, any early signs of how the simplified product line is received or how any pilot distribution partnerships perform. And finally, the obvious one. How do Q3 or Q4 results actually come in? Do they track towards that $1.45 billion sales target? That'll be a big test.
So checking if the plan is translating into actual results.
Pretty much. And looking at a bit further, the medium-term story really comes down to one thing. Can they get unit growth going again without sacrificing those hard-won gross margins?
Yeah.
Can they prove this reset generates real, sustainable growth, not just temporary savings from cost cuts? That's the billion-dollar question. Maybe literally, the market needs to see demand come back.
Okay. Well, this seems like a good point to transition to our This Is Not Financial Advice segment. Just a reminder, everyone, this is purely for discussion, maybe sparking some ideas. It is absolutely not a recommendation to buy or sell anything. Please, do your own homework.
All right, so given that sharp negative reaction right after the Q2 earnings, but then, interestingly, the stock did bounce back quite a bit from its June lows, went from under $7 to over $9.50 by early September. Creates a kind of fascinating setup. So my outrageous but plausible trade idea is this. A long position in Sleep Number stock, ticker SNBR, but, and this is key, with a tight stop loss set just below recent support levels, and then pair that with selling out-of-the-money call options against the stock position to generate some income. A covered call strategy.
Okay, long stock with a stop loss plus selling calls. Walk us through the outrageous versus the plausible parts of that.
Right, the outrageous part. You're betting on a turnaround for a company selling big-ticket discretionary items, mattresses, in what's still a pretty promotional environment. Plus, they just had that huge top-line miss and leadership changes.
It's definitely betting against some significant headwinds. It's contrarian, for sure.
That feels appropriately outrageous. What makes it plausible, then? The plausible angle rests on a few things we've discussed. One, those massive cost cuts, over $130 million in OPEX reduction, is nothing to sneeze at. That provides a cushion. Two, that shockingly good gross margin holding flat despite the sales drop shows some underlying operational strength or discipline, at least. Three, those early signs of marketing getting more efficient. The 24% conversion lift is real data. If that continues, it's a big lever. Plus, management is talking to lenders. They're aiming for breaking cash flow soon. They do have product and channel plans for 2026. And importantly, the stock already showed some resilience after that initial Q2 shock. It didn't just keep cratering.
So the bet is the market overreacted initially and maybe hasn't fully priced in the potential upside if this reset actually works.
Exactly. You're betting that the aggressive cost savings and efficiency gains start to compound and eventually fuel growth without wrecking margins. The covered call part just provides a small income stream, a bit of a buffer, while you wait to see if management can execute. It slightly reduces your risk if the stock stays flat or drifts down slowly. It's a bet on execution, pure and simple. Execution of this reset plan.
Okay, a lot to think about there. And that brings us to the end of our deep dive on Sleep Number's Q2 2025 earnings. We've definitely seen a company in the middle of a very ambitious hard reset. Aggressive cost cuts, big strategic pivots in marketing and product. It's a bold plan.
It is. And while that initial market reaction was definitely cautious, management seems laser-focused on getting the company positioned for longer-term growth while keeping their finances stable. The next few quarters are going to be absolutely critical. We'll see if these big moves start translating into better demand and, importantly, sustained profitability. The key question, really, is whether these changes are just, patching holes or if they're building a genuinely stronger foundation for the future in a pretty tough market.
Absolutely. And just one last reminder, everything we've discussed here is for informational purposes only, definitely not investment advice. Please do your own research, maybe talk to a financial professional. Thanks for tuning into the deep dive. We'll be back soon with more insights from the market.